Hey, badass business owners. Today we're going to talk about a balance sheet. And I know right now you're wondering, what on earth is a balance sheet and do I need one for my small business? Well, today we're going to take a look at what that is and if you need one. All right, what is a balance sheet? In the short version of it, it's basically your business's net worth. Now, you're probably wondering, what on earth is net worth? Well, it's basically what you own, otherwise known as your assets, minus what you owe, your liabilities. And if you put these two together and you take your assets minus your liability, it's going to equal your net worth, or the wealth of you. So when you're thinking about your business, it's the wealth of your business. It's what your business is worth. Let's take a look at some examples here, okay? In your personal net worth, you're going to have assets like your house, your car, your bank accounts, retirement, anything that you have that you could exchange for money, basically. And your liabilities typically are your mortgage, loans, credit cards, anything you owe the IRS, stuff like that. So if you take your assets minus your liabilities, it equals your net worth. So if your assets equal up to $250,000, which is common if you have a home, minus your liabilities, because remember, you can have a mortgage, credit cards, things like that, your net worth is considered to be $70,000 in this case. Well, you also could be the other direction. Let's just say your house still and everything added up is $250,000, but you owe a lot more. You've got a lot of credit card debt. You owe a lot of people money. You could have a net worth that is less than zero, in which case you have a negative net worth in this example. So when you think about your business, your assets and liabilities are a little bit different. Your assets are going to be cash. Accounts receivable is anything where people owe you money, any inventory that you have, because you can turn around, you can sell it, property, equipment, things that you can exchange for money, or money that people still owe you. Those are going to be your assets in your business. Your liabilities in your business are going to be accounts payable. This is money you owe other people. Any loans, debt, taxes owed, and stuff like that. So the same thing would be for your business. Your assets minus your liabilities is going to equal your net worth. So let's say you have assets of $50,000 when you take in your inventory and your equipment and stuff, minus the $30,000 you owe other people. Your business might have a net worth of, say, $20,000, or vice versa. You have $50,000 in assets, but you owe $70,000. You have a net worth of negative $20,000. You owe money to other people. So your business's net worth is going to work very similar. But let's go back to this. We're talking about a balance sheet, and you would think a balance sheet has to balance, right? So how do they do that if some cases you're going to have more money than you don't? So on a balance sheet, the key is A equals B, right? That's what we think of when we think balance. So in this case, we look at our assets equals our liabilities, but the reality is, even in our examples, they don't. So how on earth do you get to the part of balancing? Well, the way that a balance sheet works is they add this third component to it called owner's equity. And this is you as the business owner, your equity in the business. And that's going to fluctuate at different times based off of the decisions you made. If you decided to be debt free and you don't have any debt, your owner's equity is going to be much higher. If you've gone into debt, or you've made decisions to purchase stuff at different months, that money might go up and down based off of money you pull out of the business to pay for things. So for example, let's just say you have a positive owner's equity, but yet you go out and you buy a new truck or a new vehicle or a piece of equipment. At that time, your asset will go up because you bought something. Your liability will also go up if you did any kind of loan or anything attached to it. And if you bought it for cash, your liability didn't go up, but your owner's equity went down in order to pay for it. Because one way or another, what goes in goes out, kind of a thing. So let's take a quick look at an example. This might help it make a little bit more sense. On one side, you've got two different sides of this. The first side is your assets. This is the money, the things, the items that have value to them. We'll take a closer look in a minute. And on the other side, we've got our liabilities. Remember, our assets and our liabilities. But then we added this third component over here of owner's equity. So our liabilities and our owner's equity is going to make up that side. So you'll see here where we get the balance is on the left side, our assets are $47,000 and our liabilities and equity on the other side are also $47,000. Take a closer look here. When you're looking at asset, remember, it's anything that you can exchange for money, turn in. In this particular business example, you got cash, money people owe you, inventory, supplies, etc. It came up to the $47,000. Where on the other side, we had our liabilities, money we owed people. So if we owed people money already for their wages, even if we haven't paid them yet, we still owe them money, right? Because we always pay our payroll backwards. So sometimes you owe people money, credit card debt, stuff like that. That's how we came up with the liabilities. And our owner's equity side, there's money that's retained in the business for future purchases and money that you may have put in or the money that you could take out at any given time. Owner's equity of 13. Go back to our example. Left side, 47,000, liabilities 34, owner's equity 13, and together that came up with that 47 on the right-hand side, which mirrored our assets over here. Once again, they balance with each other. Now, I know that's short, sweet, and to the point. It's just to give you an overview of what a balance sheet is, and hopefully that's going to help you out. Now, you can ask for your accountant to give you a copy of your balance sheet. More than likely, if they already run your numbers, there's a balance sheet already included in that packet. You just got to open it up and look at your P&L because it's in that whole stack of stuff. When you get your profit and loss statement, there's usually a copy of your balance sheet in there. And if you don't have an accountant, you do it on your own. Sometimes your programs can do it. If not, you can easily create one just using the examples that we have in our video here. You can go back and kind of jot some notes down and you'll be able to do it. By the way, I do cover it in our course as well. Now it's your turn. Go do the math. Go play around. Go look at your assets minus your liabilities to equal your owner's equity to get your net worth of your business and see what you did. All right. Now, if you like what you see, don't forget to hit the subscribe button, ring that bell, and like it and all that good stuff. And like I did mention earlier, I do have a course, Know Your Business Numbers course, where we take a deeper dive in and we try to help you understand all of these different business numbers that are coming at you as you run your business, and we try to make them a little bit simpler for you. Now get out there and be the badass that I know you are.